This episode is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Hey, greetings and Happy New Year. I'm Samantha LaDuc, founder of LaDucTrading.com, and I am joined today by our macro edge manager, Craig Shapiro. Happy New Year, Craig.
How are you? Happy New Year
good.
as well.
I'm eager to find out if Bitcoin moves. You said they just announced the approval of the 11 Bitcoin ETFs, and I said, what's happening? You said, nothing yet.
Yeah, I mean, It's been a bit of a saga here, but it does look like we officially are going to have Bitcoin ETF trading tomorrow. So there you go.
Why didn't Gary Gensler yesterday, after he admitted that the Twitter handle for the SEC was hacked, why didn't they just say, you know what, we already approved it? Honest mistake, we're a day early. Anyway, for compliance reasons, maybe that's why they pulled it back, but it still seemed kind of a charade.
Exactly. I don't know what's going on over there. I mean, there's a disdain for crypto at the SEC, but when the likes of BlackRock and JP Morgan, Goldman and Fidelity want something, it's hard to tell them that they can't have it. So here we are.
All right, so that drama is out of the way. Let's talk about the rest of the drama that we're facing for the rest of the month. This is macro to micro power hour, so we like to discuss macro event risks in addition to any particular flow, quant positioning that can help exacerbate a move or trigger volatility. We do a little bit of technical, a little bit of fundamental, but for the most part, we've got some macro event risk tomorrow, CPI, and then we're anticipating the February 1st FOMC and the quarterly refinance announcement by Yellen for her Treasury bond issuance. So we really want to hit those three in particular, but this is also an Ask Us Anything type of segment. So if you have questions, just hit us up in Zoom Q&A is perfectly fine. And I'll track those questions and we'll respond and go through each asset class. Obviously, Bitcoin is taking the attention right now after hours with the approval of, Craig said, 11 Bitcoin ETFs. It just hit at 4 o'clock and I literally just had an alert on it when I opened the room. All right. So what do you want to jump into first?
Yeah, look, I mean, the start of the year been challenging, choppy, kind of walked into the year and markets kind of, went straight down. Probably, some of the things that were materializing at the end of last year, which were kind of tapered off until the new year, particularly some tax law, some tax gain selling, really. If you were a beneficiary of large taxable gains in 2023 from big tech, you didn't want to pay taxes. And so you waited until January to sell, so you don't have to pay until, next April. So I think there was a bit of that dynamic in play to start the year and some of the NASDAQ underperformance. And then we had, some of the data that came out last week on labor was pretty good. And so we reduced the odds of a Fed rate cut from near certainty, which was for March, which was near certainty the last week of December. And that started to come down, to the 60-65% range now for March, over the course of the first 10 days of the year. So that had led to some risk asset correction. But, here we are this week and we're in the kind of seasonally strong flow period again. The week before expiry is a major expiry next week for single stocks. There's a ton of single stock leaps and calls that are on the tape, and that is helping the market, stay afloat. And, typically that week before expiry, a week of expiry, the flows over macro dynamic is in play. And so you need, very significant macro data points or outsized macro surprises versus expectations to really be able to offset the positive seasonal flows that come from expiry windows. And so that's what this week has largely brought us thus far. But we do have a pretty big data point tomorrow with the CPI. And, there has been a tremendous amount of call buying, this week. It seems like the volatility for calls for every ETF is higher than the volatility volatility for puts for tomorrow and for this Friday. So it does seem like folks are looking for a inline to soft CPI print, something that will firm the narrative that a March rate cut is in play. And so if that is what we get, I suspect we'll continue to see the dynamics in play where it flows over macro, NASDAQ up, dollar weak, bonds not really doing anything. And, it's possible, many of the big cap tech and maybe the NASDAQ itself could make highs kind of going into this important expiry window, next week. On the flip side, if for some reason we have a sizably hot core CPI print, we will likely sell off because we will be in a situation where the odds of a rate cut for March will need to move down substantially from the 65% level, likely, and it's below 50 and beyond, as the Fed will not really be in a position to support the very aggressive rate cut expectations that the market has for them this year if we have a continued environment of sticky inflation. So it is a fairly, I think, binary event tomorrow. That being said, look, we there's a lot of hedging that's gone in for tomorrow that came in today, and so volatility for S&P for tomorrow kind of ticked up 2 or 3 handles today, and so we no matter what happens, I suspect we're going to get some vol selling to start the day, and then the question will be how big of a surprise data point can that overwhelm some of that structural event vol selling that goes on after the events. So
let me share 2 charts with you real quick on that. As it relates to this screen that I'm showing right now, it's the weekly, the daily, and the hourly time frame for NASDAQ 100. And you were very, very right in positioning into not only the 2023 winners getting sold into the first of the year, but just all markets were very soft, soggy. But this particular gap down, which was from Friday into the Tuesday, New Year, first trading day of the year, just got filled today. And then more specifically, and this was my bet on Monday when we started, we moved down into a perfect kind of level of 394 pre-market on Friday. So Monday we had stabilization and a follow through. Anyway, this was my price target, 408.72. That's an hourly gap fill. So now we can roll back over again. So basically we've tagged on the short duration time frame. And then, and make sure I've got the right screen showing yes. And then when you talked about hedging into this Friday expiry, the 10-year futures bet is that it's going to come down a little bit. So they've been buying the 111.50 put strike for the 10-year futures, expecting a bounce basically in the 10-year yield to about 4.1%. So and SOFR has been the length has been shortening. So they've been selling that length. Any comments on the positioning that you've seen in regards to the bond market?
Yeah, look, I mean, I think we've taken out a little bit of the aggressive easing cycle that had been priced in for this year as we exited 2023 and looking for 6 cuts. So some of that has come out over the last couple of last few days to start the year. I don't really sense that the bond market is making a big bet on this print. It seems like people are kind of positioned for an inline-ish type print and maybe a continuation of the trends that we've seen to start the year, which is yields bottomed at the end of December and been gradually moving higher. I think that's probably what we'll continue to get. So I don't think that the bond market really is making a big call on this print. That being said, I do think there could be a big reaction to an outsized extreme outcome, right? So if we get a very soft core services ex housing print, it will confirm for the bond market that the Fed is ready. The Fed will be ready to go in March. And on the flip side, if we get a very strong core services, I think it will similarly, confirm the narrative that the Fed won't be going in March. And so, I hate these binary windows here, but basically, the market is reacting, much more aggressively than to every data point than the Fed is. And so it depends on how the boat is tilted into any one of these events. I think the call buying in equities would suggest that folks in equity land are expecting a soft print for inflation that will confirm the rate cutting cycle. I don't sense that similar amount of
I don't either.
euphoria in the bond market, but we'll see.
I wanted to share this as well because I think I mentioned this yesterday in my market thoughts for clients. In the short term, we have CPI Thursday, and then specifically consensus 0.2 to 0.3%, which has been in the past very, very market moving when it comes in soft. We had a massive gap up on November 14th. We had a smaller move higher, but still very strong on the December print for the November time period. And that also continued higher, as we know, right? 12.12. But this is different. We also didn't have the equity positioning, which was extremely oversold back on that November 1st, November 14th time frame. Now the positioning is extremely stretched, right? I mean, this is really GS Prime book long. This is 86th percentile. The CTA's long positioning 95th percentile over the past 12 months. So we really have, I think, stretched this Santa rally that was front run in end of January, first 2 days of December, and then first 2 days of January petered out. So they didn't actually follow through, but oh well, they had such outsized gains in November and December. So chances are we're going to mean revert, but I'm not expecting a small shake and bake, but not a big shake and bake as it relates to CPI in particular. So that's it. We're at a very, very different kind of market structure point with this particular.
I think that's very important. I mean, I think that it's almost like we have been, lulled a little bit to sleep by the way the volatility has fallen, and the markets have grinded higher to a large degree, over the last, not even just the last few days, but more of the last couple months. In that it is notable that there has been a significant amount of buying that has gone on here over the last 2 months, since the as you call it, the Yellen pivot. I forget what you say. How you
the Yellen
Yahtzee. That's right.
Yellen lost.
And
which timed perfectly with the Fed pause.
Yeah.
On November 1st, and the rest is history.
So look, vol control funds are very long this market. CTAs are very long this market. Retail is very long this market.
Yeah.
Everybody effectively is, even spec length is back, to overbought levels on futures.
Oh, wait a minute, I got to show that one. Don't move.
So
it's not a little overbought, Craig. This is wild.
Yeah, right. So people are long. Now that doesn't mean that we can't keep going higher, but what it does mean is that the bar for a negative surprise is lower, right? It doesn't take as much of a beat on CPI to potentially lead to a cascade of some selling. But we need to have a volatility event to start to dislodge some of that length. And so the only real way we could get that kind of volatility event, in my view, is if we get it to start with the rates market, and that would be in a yield up type way. And so that is a positive surprise on inflation that I just saw another headline here about Bitcoin. I don't know, this thing's all over the place. Sorry. Another positive I'm
going to look right now.
Sign
That's my job.
From inflation that makes it more difficult for the Fed to deliver the rate cutting agenda that is being priced into the market. That is the crux of the volatility event. That is how volatility would start to move higher. And so we need that kind of surprise. And so it would come from a hot inflation print, and it would come from Fed speak. And so to confirm that, now we had Williams out this afternoon. We had Logan out over the weekend. Mester was added to the calendar tomorrow morning, and there will be other Fed speak. And so the question is, after the CPI comes in, let's say if it comes in, whatever how it comes in, the Fed will then come out and kind of speak in that direction, right? If it comes in hot, you will hear from the Fed talk about, well, financial conditions have loosened materially. That's not really our intent. So they'll push in the direction of the CPI print, which could then create that dynamic where yields move up, the dollar moves up, and risk assets start to get sold. On the flip side, if it comes in particularly soft, and even Williams today in his speech mentioned that there has been significant significant momentum on services inflation moving down. If it moves in that direction, you'll probably hear a Fed that it becomes, more sanguine with the idea of a potential for a March cut. So those will be that's the 1-2 punch that we'll get in order to create this volatility window. And maybe it doesn't happen next week because of the OPEX, but on the after that, the window of weakness is potentially open. We also have a ton of earnings that start on Friday with the big bank earnings, and then all next week and the week after.
But it's so hard to trigger volatility until after the Magnificent Seven earnings report, typically. I mean, one is way at the end, but at least Apple. So we got to get through FOMC and Apple and the QRA before you can really set free.
No, I agree. I mean, look, next week is the OPEX week. The week after that is kind of a slow macro data week and a slower earnings week. It's the last week of January and first week of February that combined. You'll get your Fed meeting, you get your Yellen QRA, and you'll get most of big tech earnings on the February 2nd. That is the time when, if you're looking to take vacation after the holiday, don't take it that week.
No.
Because that would be your, the window here where, the rubber hits the road. Macro could really matter. It would overwhelm flows, and we'll see how that plays out, because that will be, the Fed will have to, first Yellen will decide whether or not there is more bills or bonds, issuance coming in the second quarter.
Yeah,
the Fed will react to that.
I want to bring that up in just a minute, because I'm trying to look for any other kind of market mover. Obviously, big tech, but collectively, at what point, right now, especially the AI themed NVIDIA and Amazon, Meta, and Microsoft are actually breaking out of very, very strong levels, and they look good. But the point is, at some point, a case of gravity or a trigger that we don't know about. But we do know that right now, the dollar yen has definitely pushed higher. Dollar yuan looks like it is ready to do the same. Any comments on Asian currencies, because they look busy, and that can also very much tie into a yield spike, a dollar spike, which is a headwind to equities.
I mean, certainly one thing that is concerning for me is Chinese growth momentum. I think that China assets act horribly. Dollar CNH, as you mentioned, has continued to grind higher to start the year, and chart's starting to look a lot better. I mean, oil doesn't trade particularly well. As Saudi has cut prices globally, and we're sitting amidst a more bloated inventory situation. Copper doesn't look particularly good. I've mentioned Chinese equities have been, I think, down every day this year so far. So yes, there's talk of stimulus, but there's always talk of stimulus in China. I mean, it doesn't seem like bazookas are coming. We know that there's a Taiwan election this weekend, and who knows how that exactly will go. I saw the U.S. is actually sending some representatives to Taiwan to observe the election, which I'm sure is going to annoy Xi and team. So something in China seems off. And there's clearly China is such a significant part of global growth momentum that I'm concerned that the economic momentum in China continues to deteriorate, and that could be a headwind for global growth and commodity prices. And there's a follow-on there to Europe, and Europe's economic momentum has been pretty poor as well, particularly in Germany. So I don't think global growth momentum is very robust, maybe just outside the US. So the Chinese RMB move has been notable. As far as the yen, kind of a confused one there. I think, dollar yen has been rallying as Japan's data has come in a little bit softer on the inflation front. And as the rest of the world starts to talk about not needing hikes anymore and potentially cutting, maybe Japan will never get off zero. Right. And I think that's, even some of the more recent commentary, from Japan has been, at least after this earthquake, that they're probably pushing back any start time of their rate normalization process. So the weak yen has been helpful to the Nikkei, making 30+ year highs here, as Japan's largely export economy benefits from that, from that weaker yen.
But the rising dollar yen complex since last night's data, they had a 10-year bond auction. They also had wage inflation. It softened a little bit, but inflation obviously is not gangbusters. They're not so worried about that causing the bullish, the dovish potential with BOJ, but it is helping company margins tremendously. So they're banking, and Nikkei, of course, is breaking out, which is really key.
And with energy, the problem, Japan runs into a problem when oil's up and the dollar's up, but when the dollar's up and oil is down, that's kind of that's a great spot for Japan because they're such a big energy importer. So the fact that oil prices and energy has been more muted lately, I think has been a real benefit for the Japanese economy. And so if they could get lower energy and weaker yen, that like you said, that's kind of their holy grail. So Japanese equities have been pretty good. So I don't think that the dollar yen move per se is kind of, concerning for global risk, but I do think the dollar RMB move could be a more concerning one, going forward to the extent that China's growth momentum continues to slide.
Okay. All right. So then back to QRA. Just wanted to interrupt that broadcasting because the dollar yen had made a decisively strong move above 145, which was a key inflection point for me. And I know it was on better economic data, for lack of a better word, in corporate earnings and, a dovish tilt for BOJ, but it's also very tied typically to strength in the US 10-year yield and dollar. We haven't had any move yet. CPI, I actually expected dollar weakness for a little bit, but in any case, we have moving on, dollar yuan, dollar yen, Asian currencies are right now looking very interesting, but we need some follow through. And we have CPI, we really don't know, it's binary. Moving forward to the QRA, which is all eyes. I mean, even McElligott got quoted today in Charlie McElligott from Nomura in regards to all eyes are on the QRA. This never used to be a data point that retail would read about in Market Watch. I was like, seriously, this is, and then he's talking about coupons and, to educate. So talk about what you know on the QRA front. Are you expecting more T-bills or bonds? What's kind of the breakdown? Because one is liquidity providing, one, liquidity sucking. It matters, but we won't know until after the event. And by the way, what is the date exactly? I just have it in my head at the end of January, but there's a specific date.
Yeah. So we'll get the read on total amount of debt to be issued and the cash levels for the end of the first quarter and at the end of the second quarter. We'll get that data point at 3:00 on Monday, the 29th. I think that's the date. Let me just confirm. No, but that's the 30th.
Yeah. Okay, that Monday 29th, Monday, 3:00.
Yes.
And then FOMC is Wednesday,
the 31st. And then so at 8:30 on Wednesday morning, the morning of the Fed meeting, that's when we'll get the composition of bills versus bonds from Treasury. So it's kind of a 1-2 punch on data. What we do know is that, and this number will come out tomorrow from on the monthly budget steam, but the CBO has already forecasted this. Deficits in the first quarter of fiscal 24 were $509 billion for the government. So we're talking about an annualized deficit of $2 trillion this year. I mean, the numbers are massive. Tax
and
receipts.
1 trillion, I actually tweeted last week, was done in 15 weeks. So it's kind of got a hockey stick going on. Why is that?
It's just, spending has been off the charts. Tax and interest rates have been, higher than forecasted for the government. And tax receipts have come in worse than expected. And part of that was, lack of capital gains, paid in 2023. Part of that was, kind of a softer labor economy. Part of that is, just the dynamics that were in play. That part of that is I believe is the increase in wages. So the expense side of the fiscal of the government's balance sheet is just, I think, is out of whack. So I think what we're likely to get from the QRA announcement is an announcement of bigger than expected need for issuance. So I think in 2024, the Treasury has to refi $9 trillion of its debt, which is, a very big number. And then it needs to finance somewhere between $1.5 and $2 trillion of deficits. So there's a lot of debt to be be sold this year. And the question, what Yellen said at the last QRA announcement is that there will be one more announcement of larger duration issuance in the second quarter than there was in the first quarter. So we know that there's going to be even more duration in 2Q than there will be in 1Q. The question will be how much, and that was what happened.
And the disposition of it.
Yeah, well, duration meaning not bills, meaning bonds.
Yeah. Okay.
And so what happened in the end of October, early November QRA was there was an expectation that she was going to announce the issuance of a lot more in duration than she did. And part of the reason, it seems in hindsight, about why she didn't do that was that term premiums had gone from incredibly negative to positive. Obviously, yields had moved from 4% to 5% the long end. And so
that freaked her out.
It seemed like, a pretty logical political decision by her to say, maybe I won't go and issue as many bonds this time as the market may think I'm going. So that's basically what she did. And so the question now is she going to do that again? Now that bonds have rallied 100 basis points and term premiums are back to negative again? I think the answer is no. I think she is not going to give us as many bills as bonds like last time. I think she is going to issue more duration in the second quarter than was for the first quarter. And so I think there is risk at that point in time. And as we get closer, I'll start to work on how big of a risk and what the numbers may look like. But it seems like there is risk that she will announce larger duration issuance for the second quarter than not. And so
it would align with my timing for a pullback. That's all I can say. I just don't think it's going to come very sizably during the month of January until we get the information. I don't know. It definitely, I say we're overbought but not broken. We need a trigger. That would be a good trigger.
Yeah, look, I think the fact that everyone's looking at this again, the fact that people are really focused on this maybe creates, some, risk into the event. So sell buy the rumor, sell the, whatever, however you want to think about it. So maybe we trade a little bit ahead of it, but regardless, there is going to be a lot of duration issued, every month, more every month going forward. February will be more than January, March will be more than, and we'll just keep issuing more and more duration. So, there is definitely risk on that front. And it comes the same day as the Fed meeting, later that afternoon. And there's been some talk recently from Logan over the weekend about potentially tying in the pace of the balance sheet reduction and the RRP and how that kind of plays into case, because the RRP has been drained significantly because of the bills issuance. And so the idea that some have is that, well, if Yellen announces more bills again next quarter, we're going to drain the RRP. And Logan over the weekend said, well, we can't drain the RRP. If we drain the RRP too quickly, there'll be risk there. And so we need to then maybe taper QT sooner. So a lot of this kind of plays together. It's hard to really forecast. It's more like we need to react to what happens. When Yellen announces what she's going to do, we'll be able to trade accordingly, maybe a sell all assets type event. If she comes out and announces the issuance of a ton of duration at the same point in time, the Fed comes out and says, we're on hold for January and we're likely to be on hold for March, right? You can start to paint the picture of why February may be more challenging.
What do you think would be more bearish? The Fed actually admitting that they're considering cuts, or that they actually announce they are going to in March?
I don't anticipate that they're going to announce that they're going to be cutting in March. Look, the question is, why are they cutting?
But what if they do? It's just a theoretical question.
Yeah, look, I mean, I think it's, again, though, I think if they announce that they're cutting because they're concerned about this Chinese growth situation and growth momentum, I think that would be a concern. I think if they say that they're cutting because of this real rate normalization type cuts, I think I think that people will say, oh, that's what we want. Thank you. That's what we want. That's what we want to see.
Yeah.
So
they're not going to talk about China, but they normally.
Yeah. So I guess that's my point. I think that the rationale behind why would they be starting in March, I think is important. So if it's really just about rate cut normalization, that's what people want to hear. I think if it's about, oh crap, the economy is slowing more rapidly than we thought, I think that would be more of a concern for.
Okay, and explain real quick just on the rate normalization, because not everyone follows that so closely as it relates to real yields and decelerating inflation, or at least headline inflation.
Yeah, there's this dynamic that the Fed has become particularly enamored with, and I kind of think it doesn't make a lot of sense, but they get to make the rules. And basically what they say is that as inflation is falling, in order to keep a consistent level of restrictiveness or accommodation, they need to react to that fall in inflation. So as inflation falls, if they do nothing on rates, they are actually getting more restrictive in policy, and they don't want to be doing that as they're approaching the 2% target. So they will be cutting interest rates kind of in line with that fall in inflation. And that's really the justification behind many on the Fed looking for the 3 rate cuts this year, is they see inflation down near 2.25% or 2.5% at the end of 2024. And so if they did nothing, then real rates which are currently say 5.25%, if we ended the year at 2.25%, real rates would be positive 300 basis. And in their view, the economy could not handle a positive 300 basis point environment. And so they need to be cutting in order to keep real rates more like 150 or positive 200 basis. Now, I think that given where borrowing is now and how corporates and consumers are largely locked in at low rates, and they're less impacted by this move in real rates, that the economy actually could handle, that elevated level of real rates. But the entity that could not handle that elevation in real rates is the U.S. government. A positive 300 basis point real rate environment is what will crush the U.S. government's finance. And so I think that the Fed is being political if this is their rationalization. They are saying, we recognize that the U.S. government can really not afford a positive 250 or 300 basis point real rate environment. So that is why the Fed is cutting rates, because the government can't afford it. So this is more, to me, evidence of fiscal dominance. This is the Fed realizing that the U.S. government's finances are in such a precarious situation that they have to be cutting rates in order for the government to be able to finance itself. Because if it wasn't that, they'd be looking at the tremendous loosening of financial conditions that has taken place over the course of the last 10 weeks. And Logan's speech over the weekend really gave a good overview of, she referenced 4 financial conditions indexes that she looks at, including the Goldman Sachs one, all of which would show a tremendous amount of loosening that has taken place. Some of them are historic amounts of loosening of financial conditions. And it's clear that when you loosen when financial conditions are as loose as they are, there is a reaction in the economy and in asset prices and in wealth effect that kind of drives much of consumer behavior. So you could imagine as financial conditions have loosened and stocks have gone up, folks are spending more money because they have more money to spend. So
I got to segue into that because that's one of the questions. Finish your thought, but it'll be.
We're in this weird place where the Fed has stated that they're looking at real rates, but financial conditions have loosened so mightily that we run the risk that inflation expectations will become unanchored again, move higher, and that by the middle of 2024 we'll have an inflation reacceleration into an election, which would be a very tough situation for the administration and for the Fed. So I'm not sure why they're going down so aggressively this real rates path. This is, I think, why in the minutes, which I mentioned, talked a little bit more about the concern on financial conditions and that they're monitoring it. If they get too loose, that's self-defeating. Logan mentioned it as well. And we'll see if Mester and others maybe talk about it tomorrow after the CPI print. I think the Fed tries to say they are watching financial conditions. They don't want them to loosen too aggressively. That would be self-defeating. I think, again, that could help push back against this market's idea of imminent March rate cuts and 5 to 6 rate cuts here.
Okay. If Peter makes a mention, historic rate normalization over the long haul is more like 5% on the bottom of the range over like 40 years.
Yeah, look, I think the Fed has not moved on this idea of what long-term neutral rates are. They've kept them low at 2.5%. They have not moved much in the belief that we're in a structurally higher inflationary environment and that normal rates need to be higher. The Fed's just not moving rapidly in that direction. I think they should, because I think there are structural issues on inflation regarding demographics and regarding commodity supply and demand, deglobalization that are going to factor in, and populism, wage effects that are going to lead to more inflation over time. The Fed's just not quickly making that decision, and so they're kind of sucked into this real rate argument, which I think ultimately will be a pretty bad choice down the line.
All right, so this is just kind of a comment. I'm just pulling up your tweet when you were talking about the government is literally worst off for the higher yields, and potentially why November 1st we got the Yellen Yahtzee, because 10-year was at 5%. But you talk about revenues are up in the fiscal year for first quarter. The revenues are up 8%, but expenses are up 12%. Now, question on the $2 trillion that you referenced in deficit expansion for 2023. What is forecast for 2024 that we can count on?
Well, I was talking about 2024. I mean, basically, in 2023, we did it. If you adjust for the student loan stuff, which not everybody does, we actually deficits were 2 trillion in fiscal 23. I was just looking at the 509 or even the 553 in annual, and that was for the first quarter of 24, and annualizing it and saying, well, that's a $2 trillion run rate. I know the first quarter is a little bit higher than the last, and maybe there'll be some momentum on the budget, leads to some less spending, although I wouldn't count on it too much. So, and maybe there'll be some more tax receipts because capital gains have been stronger lately. But ultimately, we're talking about 1.5 to 2 trillion in deficits this year. I think the CBO will give an updated fiscal 24 update next month. So we'll be looking out for that. But I expect the momentum will be that number is moving higher.
And then you just mentioned obviously this loosening of conditions that Lori Logan pointed to extensively this week for, in particular, I'd love to know which four they are, by the way, but in any case, besides the Goldman, references to how loose conditions are. And you mentioned that this kind of triggers or spurs this continued. I mean, obviously the equity speculation, not necessarily CAPEX, that's falling off still, but consumer credit, it has really exploded past month, and it continues to show borrowing costs just rising. So they are spending, which is also helping companies, beat expectations, and then of course delay recession. Question was, what's your takeaway of the recent consumer credit report? Would that spike in spending cause deflation to slow down, or disinflation? I think is a better word. But
yeah, look, I mean, I think oil prices also will matter in this analysis. There could be some wallet share shifting going on as oil falls and gasoline falls. Maybe consumers can afford to spend away from energy on other things, and we know wages are moving up for 24 at the federal government level, and really across industry. Cost of living increases for Social Security, I think, are up 3 to 4%. So I think consumer spending overall 2024 will remain fine, will remain okay, but it's clear that the consumer is getting more and more stretched, and that's evidenced as that credit card data is showing. So I don't think we can maintain the level of spending. We've drawn down savings materially, and certainly at the lower middle income levels are getting much less of the benefit from higher asset prices like the wealthy get. So I think the idea for 2024 is that consumer spending growth will continue to decelerate, but likely still to be non-recessionary.
So that's a view for this year moving forward, as it relates to the work that they did last year to keep us out of recession. Let's just kind of talk about these three. I want to show you, if I can get the right screen. I spoke about these yesterday. I was basically kind of looking at the efforts that have been done to kind of keep the cost of inflation, under control in order for us to have this no landing that we've achieved in 2023, not the least of which is the equity advance. So cost of labor, you had just referenced energy, which has kind of triggered this thinking. Cost of labor and energy, definitely the White House has expanded immigration to help fill the slack, the labor slack, so it didn't get too tight, obviously, and drive up wages have obviously been very, very firm and rising, but relatively speaking, it would have been a lot worse. 2/3 of all jobs in 2023 went to foreign born, and all jobs created have been filled. It's crazy metrics as it relates to since COVID. So they definitely through policies and not for or against, just support that the labor market has calmed down or balanced, because a lot of these policies have allowed immigrants to pick up a lot of the labor slack. Also, oil, this intervention of whether it be the Strategic Petroleum Reserve or what have you, they have definitely kept oil prices from spiking. Cost of higher yields, we already talked about that. Yellen Yahtzee is definitely a big one. So are US dollar swaps with friendly central banks like Bank of Japan, UK. We do a lot with the ECB, and that has definitely coordinated with Fed stepping down, right, from the rate hike regime to a pause, and now even talking about pulling forward cuts into 2024. And then this whole cost of the fiscal spending is still, to me, the biggest unknown. I mean, I know you're extrapolating best you can, and the QRA, we're trying to figure this out in anticipation. But what do you think moving forward, especially in the election year, might change? And then, these policies, if we see any change in oil pricing, any reason whatsoever, we haven't had it yet. It looks actually quite weak. Then we'll have more triggers for inflation, right? That oil as an inflation hedge. But so far, we don't have anything in the house, right? Labor's gotten really balanced. Unemployment rate is still really below the 4.3% needed to really trigger recession worries. Yields have fallen, dollar has fallen. So right now, going into the new year, it looks very bullish. And if they spent $2 trillion last year, what the heck are they going to spend this year to make sure the election goes smoothly? Any comments on those kind of key areas for this particular year?
Yeah, look, I mean, I think as I'm kind of looking through your list, what we know is that the Fed has embarked on a fairly historic rate hiking cycle to slow down the economy. And that has had, some success and will continue to have success as we move through 24 and more people and companies are faced with the reality of refi, right? And refinancing, right? I mean, this has been, one of the reasons why the rate hikes didn't do as much to start, because consumers and corporates were largely locked in with low borrowings post-COVID, locking in 3 and 5 year borrowings if you're a company at low rates, and a 30-year mortgage if you're a consumer, if you had a home. So it took longer for the rate hikes and then the balance sheet reduction to kind of hit the real economy. But it is hitting the real economy. It's hitting housing, it's hitting autos. You're seeing in that credit card data, right? We're starting to see slowdown, and we saw it clearly in some of the global markets as well. We've seen the European slowing, Chinese slowing. We've seen other areas of the world that are slowing too, because they're all faced with higher cost of capital as well. And so I think as you push through the early part of 24, we're going to continue to get the effects of that tightening playing out. And I think that is what folks are concerned about, that the recession, which people have maybe been calling for a year ago that never came, is that it actually is going to come. And we had a pretty terrible ISM services report last Friday, which kind of surprised me. I wouldn't have expected it. And the market ISM for services wasn't nearly as bad, but there was something pretty bad about that services report, and the employment component of that report was pretty bad too. Doesn't have perfect ability to forecast, but does show that there was even more of a slowdown kind of exiting 2023 than maybe people realized in the underlying economy. So it's possible that we're going to just kind of walk into 2024 and we're in the midst of this slowdown that starts to get worse. And we're seeing some of the early reporters from earnings who are talking about that kind of slowdown, right? Some of these semi companies that have negative pre-announced, and talked about FedEx and Oracle, MSM yesterday, and several others that have really talked about this slowdown in the economy, particularly December being slower than October, right? So the run rates were not great. So I think this is why the Fed is thinking, okay, we've done a lot. It's time to stop. And we will give accommodation back to a slowing economy when we are convinced that inflation, really is falling back down to 2%. I think the issue is that those things that you put in that chart before are slow to react. And the biggest one is labor, right? Wages will be
lagging,
the slowest to react to the slowdown in the economy, because companies have spent the better part of 2 years looking for qualified labor. They don't want to lose qualified labor. And if all they keep hearing is that, well, it's going to be a soft landing, we may not even have a recession, the Fed's going going to start to cut rates, the companies are going to say, well, why am I firing anybody? Why am I getting rid of people if I'm only just going to have to try to bring them back? So we're kind of in this bizarre place where they have to keep the labor, and the wages are, remain firm, but the economy really is not reaccelerating. So I think one of the casualties of this environment that you speak of, that we're talking about, is corporate profit margins, right? You have higher wages, you have higher interest expense coming as companies have to refi, and you don't have the positive price momentum anymore. And so kind of slower top line growth, larger expense growth, larger interest expense growth, and that's a recipe for negative corporate profit margin momentum. So I think that is why equities, in theory, should struggle in 2024, because you're just not going to get enough of the growth. You're not going to get enough of the inflation reacceleration to get prices back up, and you're not going to get a consumer that is getting materially better than he was last year, as his savings have been run down and the pace of his wage increases, albeit still good, are not as high. That makes it difficult for corporate earnings to show double-digit gains like that are kind of being forecasted by consensus right now.
What's your view on the yield curve right now, 2 and 10 specifically?
Look, I think my framework is that the Fed will be slower to react to this slowdown in growth because inflation is stickier. But eventually they will react. So I do think by the middle of this year they're cutting rates, and I'd be looking for 2s 10 steepeners as we move through the year. I think ultimately the U.S. government's balance sheet is in a horrible place, and we continue to lose foreign demand for treasuries for a variety of reasons, which I've talked about. And so I am a big kind of long-term seller of the long end, 10s and 30s in the US. I think yields will over time continue to grind higher. But if we have this more recessionary type data, let's say over the course of the next 3 to 6 months, I agree it's harder for bond yields to really rise materially. But I think as we go through that risk off event, that's when you really want to be legging into selling the long end. And so I don't think we're going to see a 3% 10-year. I think we're more likely to see a 5% 10-year. But I could see us going from where we are now 4 to 3.5 on the way to 5 very easily. I'd be surprised if we got below 3.5 this year, or really.
So that's why I'm pointing with the black arrow. This is the 2 and 10-year, and it has a 0.6 ratio, which we're not right now. We're at like 0.35 or whatever it is, but we're going to tag that. We're absolutely going to go and hit that at some point. So I'm just trying to kind of help with timing. And the other is I'm a big believer in gaps getting filled, is also the 2, and I want to bring this up if I can find the blasted thing. Hold on. Oh darn, you know me in these charts. I'm kind of like low tech. Where'd it go, Craig? It's disappeared on me. This happens a lot. There it is. All right, there's your 10-year future, and they're literally right now expecting a little shimmy here down to that 110.50 put area. But long story short, this right here, the 101 in the 2-year future, that will fill at some point. So it's timing that pullback. What's your best bet time frame? We need a little crisis. We need a little macro trigger for that to happen.
Look, I think we are in that services ISM number really kind of spooked me. I know maybe I'm giving a little bit too much weight potentially to it. We know manufacturing has been mired in a recession for the better part of a year, but if we are losing the services momentum as rapidly as the December reading would suggest, that suggests that we are kind of imminently moving into a much larger slowdown in the U.S. economy, and like right now. And so I think if this is going to play out, the way I see it playing out is we get this growth data sluggishness now, and we have a Fed that is not reacting quickly. So risk assets kind of sell off even more, and maybe that gets exacerbated by the Yellen duration issuance concept in January, and that leads to broadly a crappy earnings season, right? Maybe we step over a low bar on the
It's
fourth
a low
quarter,
bar.
but the outlooks are not very good. And so you have an environment where risk assets can really set to sell off in February and March on back of, the perceived, okay, the Fed's not ready to do anything. Treasury's issuing a lot of duration. Corporate earnings don't look particularly good. Folks are already very long. And, over the last, seasonally, February, March in an election year has typically not been a very good time to be invested in risk. So I think that's how it plays out. And then maybe by the middle of March, and we're starting to think about this March rate decision. That's when, plus we also get the elimination of the BTFP, which has kind of been confirmed today by Williams and Barr earlier. So again, more liquidity drain. So
Is that beginning of March or end of March?
March 11th.
Thank you.
Is the day that expires, but it's still a year program, so you could borrow money for a year. It's just there'll be no addition. So
it is. Okay. I have 3 charts up here. I want to go over before we kind of lose our hour. Oil, given some of what you're talking about as well. We just talked about yields. Oil still has a weak spot. I know that they don't want it too high, but I wonder if they don't mind if it falls even further. Anyway, we definitely have lack of open interest. Bob, our oil trader on the desk, reminds us it's definitely much more about demand destruction than supply disruption. And I'm just showing a monthly chart again, since we're talking about looking ahead, yields and dollar and such. This just looks kind of like weak sauce. But what I don't. So first of all, any comments on oil?
Look, I think oil is suggestive of supply demand imbalances that are being driven by a slowing global demand environment. And we know OPEC Plus has tried to restrict barrels from the market, but they haven't been doing a good enough job. And Saudi actually, announced price cuts, for globally for January. U.S. production has surprised to the upside despite fall in the rig count. And so there's just too much oil around, it seems, for this current demand environment. And so I think that oil is suggestive of a global economy which is worse than people realize. And so yes, I know positioning is pretty bad. Folks are short, but unless there is a even further escalation of strife in the Middle East, which hopefully doesn't happen, but is always possible, it seems like oil is moving lower. And the question is that something that Saudi and UAE and Russia are okay with? And I think that it seems like they are. It seems like they recognize that oil moving to close to 95 in the third quarter and yields moving to 5% was something that nearly broke the economy again and broke the global bond market. And so that's not an oil price environment that works for the world, and it doesn't work for China, which is their largest customer. So they're in a situation here where maybe they can start to transition to this lower oil price regime. And if it takes bond yields down, maybe that helps them, with their cost of borrowing. Saudi did a big US dollar bond deal earlier this week at very attractive levels. So this will help them potentially sell their US Treasury reserves over time as they sell more oil and away from dollars. So I don't know. I have some conspiracy ideas about why lower oil prices may benefit them, at least temporarily here. Kind of keeps them out of the hair of the Biden administration this year too, in an election year. So maybe the next move lower is for oil to keep moving down. Destroys U.S. shale momentum.
Not that again.
We'll see. I mean, but look, I think that chart suggests more pain is likely to come from oil, coming weeks and months
until we get a manufacturing resurgence or something, and China pops up from depressed. All right, and then the last chart, I've shown this before. It's a monthly, just like that oil chart was. Since we're talking big picture, it's not like I'm trading this from my live trading room, right, where we do this every day on a much smaller micro time frame. But we're talking a lot more macro, and then trying to position for the next move. This is my intermarket read. All of my intermarket right now says stretched, and stretched, overbought but not broken. So that is basically just means that we're looking for a mean reversion, but we need a trigger, with one exception. NASDAQ Composite, to my SPX chart, is still really, really firm here on this channel. So let me just review for clients real quick, because for folks tuning in, I forget we're not doing this just privately, it's publicly, but this is something that helped me identify right in the November 2021 timeframe in this gorgeous head and shoulder pattern on a monthly, this ratio chart, and we did break down. It did fall 35%. And then we had massive central bank intervention, not just Fed, Treasury, but global as well, Bank of Japan, etc. And Matt King from Citibank estimated that to be about 1.5 trillion in global liquidity came in at the October 22 low. Okay, so fast forward, January effect 2023, March bailout, AI, NVIDIA in May, all of 2023 we already saw massive gains, right? NASDAQ was 54%. It doesn't even do it justice here from this ratio chart. But the reason I use that is because we did have a little bit of a pullback first week of January. We're kind of sitting on this channel support. If we bounce and move higher, it's going to be very 1999-esque. If we break, it's a nice confirmation that we short tech. Even though right now they look really, really firm into their earnings reports, which are coming up in the next 2 weeks. Any comments on, since we talked about how, this is just survey, but Magnificent Seven and this very, very strong indicator of rotation and concentration risk. We've shown you the futures, right? So there's just not a lack of emphasis on how productive that trade has been. Any final thoughts on, in particular, chances for gravity to kick in and basically NASDAQ to start selling off in earnest and we get this breakdown?
Yeah, look, I think we're going to need to, first off, get this kind of vol event going, right? I mean, something that kind of shakes the tree a little bit on the volatility side. Ultimately, I think that the NASDAQ or the growth outperformance versus value will happen kind of, after whatever risk, whenever we have the risk off, and when we get that eventual Fed stimulus and liquidity addition that kind of brings back and brings up future inflation again. So I'd be looking more for, and maybe an end of 24, early 25 type environment for, value over growth in a much more protracted way. But I think here, I'm not sure that the growth over value, a value over growth idea works in a slowing economy, slowing inflation type of construct. These are companies that are, still growing faster than the economy. They still have pricing power. They're still net cashed up. So I think they're still likely to outperform. The way that they go down is through the vol event, right? We need, that everybody's just kind of overly long, stocks or what have you. So again, I think the cadence is rate spike, rate vol moving up leads to equity vol moving up at a time when, the window of weakness is open, when dealers are in negative gamma and everybody's already long. So I think, as we've discussed on this call, it's possible we could start to see that in a couple of weeks, but it's more likely that if it's going to happen in around that last week, January, or first week of February, where Fed meets, Treasury meets, big tech reports. And
get it done. Let's get it out of the way.
That seems like as good a time as any for correction. Now, possible that because that's what people are looking for, it happens sooner, or but
front running. Mm-hmm.
Yeah,
we'll be back here in end of the month, and we'll do another macro to micro power hour. But for now, I think we'll covered a whole bunch of stuff here, and we'll touch base with clients, obviously, in the live trading room and post CPI macro edge roundup. For now, thank you very much for joining us on this macro to micro power hour. Thank you, Craig, again. I wish everyone a great happy new year. Bye for now.
Take care. Thanks. Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.